Nobody bought insurance today. Think about what was on the calendar. A shooting war between the United States and Iran, live and escalating. The two biggest companies in this index report tomorrow after the bell. A volatility expiration in the morning. Every reason to own protection was right there, and the market did the reverse. The fear gauge dropped 9%, and dealers sold roughly $4 billion of same-day puts. AlgoIndex market close, Tuesday, July 21st. The index finished up 0.9% at 7,509 inside a 63 basis point range, the quietest shape an up-day can have, while the chips underneath ran 6%. Three things tonight. The $4 billion mechanism that made a 6% chip day register as almost nothing at the index level. One number, below 5, that explains why the index could sit still while single stocks flew apart. And the loudest bet on the board, an 18-month wager placed on a stock the same afternoon it jumped 14%. Not one of the three was anywhere on a price chart. Here is the closing scoreboard. The close, 7,509, higher by nearly 66 points. A one-way grind. Our own 5-minute archive opens the session at 7,490, flushes to the low of 7,468 at 9:50, then climbs all day to the high of 7,515 at 1 in the afternoon, 47.5 points, top to bottom. The fear gauge closed at 17, down 9%. Its own volatility index fell 6%. Put and call open interest ran 1.27 to 1. Implied volatility rank sat low, in the mid-20s. The Nasdaq 100 doubled the broad index, at plus 1.9%. Every one of those readings says the same thing. Demand for protection left the building on a day the market went up. Start with who did the lifting, because it was not many names. The chip group carried the day, up about 6%. A leading memory maker added roughly 12%. A storage name jumped about 14%. The Nasdaq 100 ran plus 1.9%, while the broad index managed plus 0.9. Now the arithmetic. Real-time dealer hedging flow finished at a net positive $5 billion of delta. About $4 billion of that was same-day put selling. When dealers sell same-day puts, the hedging that follows leans against every move, and realized movement gets pressed flat. That is why a 6% day in the chips came out as a 63 basis point day in the index. The calm had a specific dollar size, and the size was $4 billion. On top of it, another $3.5 billion of positive delta arrived through longer-dated call buying. Aggregate dealer positioning is net positive, plus $3.61 billion on the call side against minus $2.91 billion on the put side. A 10,000-lot dealer long call at the 7,530 strike sat overhead as the ceiling. And here is the number that ties it together. 1-month implied correlation slipped back below 5, down from 6.8. Below 5 means the market is paying almost nothing for the index to move as a block, while it pays up for single stocks to fly. A 14% chip name and a 0.9% index are not a contradiction. They are the same trade, viewed from two ends. Walk the real path. The open gapped up to about 7,490. 10 minutes in, the market flushed to 7,468. Roughly 12 points under the line it defends. 7,480. That line was published before the bell. Bullish above and bearish below. Yesterday, the market closed underneath it. Today, it dipped below once, at 9:50, got bought immediately, and reclaimed it. It held it into the close for a second straight session. Above, the 7,520 to 7,530 band, where that 10,000-lot long call lives, was the lid. The market ground up to its high of 7,515 at 1 in the afternoon, and stalled right under it. The clean map into tomorrow is simple. 7,480 is the line that has to hold. The 7,520 shelf is the first ceiling, and 7,600 is the one above that. A storage name closed up about 14% at 1,589. On that same afternoon, a block of its January 2027 calls opened, struck at 2,270. Read that plainly. Somebody looked at a stock that had just run 14% in one session and bought the right to own it 43% higher, 18 months out. Not a fade of the move, a bet that the move is the beginning of something. It was not alone. A second name, up about 19% to 217, drew opening buys in a January 2027 320 by 390 call spread. Same signature. Buy the winner and reach out more than a year to bet it keeps winning. Both were flagged in the end-of-day read for confirmation in tomorrow's flow, so we tagged them as flagged, not stamped. Here is the sentiment red, and it carries an edge. Implied volatility is cheap. The rank finished in the mid-20s, and fixed strike volatility fell across the whole curve today, which means the bid for protection did not just stay low, it actively drained. So downside protection is inexpensive right now, and it is inexpensive on the exact night before the heaviest slate of the week. There is one question tonight's numbers do not answer. They cannot tell you whether selling that protection was a confident read on the earnings, or a shrug that a single headline will punish. Cheap insurance is either a gift or a warning, and the same figure supports both. We will report that it is cheap. We will not pretend to know which one it is. 3 trades, 3 wins, no losses, 31.5 points on the futures. All 3 came from the same read. The first was a long from 7,510.5 at 9:40, bought straight into the opening flush, out at 7,521 for 10.5 points, and it exited at the target to the tick, with price back underneath a minute later. The second faded a probe up into 7,534 and took 9 3/4. The third, the automated strategy, went long on the reclaim and closed at midday for 11 1/4. Every one was a dip, bought into the same put-selling cushion this whole broadcast has described. And then, all afternoon, we did nothing. 0 entries after midday. We passed on an unconfirmed touch at 2:04 and passed again on a setup that confirmed too late at 2:46. The reclaim we skipped would have paid. It just would have paid through a signature we do not trade. We left points on the board on purpose, and given the same afternoon, we would leave them again. The bias is a supported grind with a mild upward lean, and it holds only while 7,480 holds. The nearest maximum pain magnet computes near 7,490, just under the close. Above sit the 7,520 supply shelf and the 7,600 ceiling. Lose 7,480 on a closing basis, and the read flips lower toward the 7,400 support base. Last night, this desk leaned two-sided with a downward pull, and on the headline, the market went the other way. But the conditional we drew was that a reclaim of the lower line would put hedging back into cushion mode and reopen the pin near 7,490, and that is precisely the branch that ran. The lean was cautious. The map was right. The event is not tomorrow's regular session. It is after the close. Alphabet and Tesla, 2 of the largest names in the entire index, reporting the same evening, alongside Texas Instruments, IBM, and ServiceNow, with a volatility expiration in the morning and the Iran risk running underneath all of it. If you want to keep an honest score of your own trading, the journal is free. Hand it a trade, and it will show you how your entries stacked up against the prices that were actually in play that minute. It is at members.algoindex.com/auth/signup. Every level we walk tonight gets scored in the open, whether the number flatters us or not. That public record lives at algoindex.com/tools/gamma-level-accuracy. The longer written work is at algoindex.com/blog, and the trading community is on Discord by invitation. One last thought. The insurance nobody wanted today is the exact insurance tomorrow night was built to test.